So Stelios is the moderator of this panel, and I'll actually introduce Stelios, and then there'll be 45 more minutes of introduction to Stelios at the end of the day. So Dr. Stelios Papadopoulos is currently co-founder and chairman of the board at Exelixis, chair of Regulus Therapeutics, co-founder and chairman of Epicast, and sits on the boards of Graviton Bioscience and Ovid. His leadership experience also includes, of course, as we know, serving as the chair of Biogen for a decade ending 2 years ago. Dr. Papadopoulos had a successful career in investment banking, specializing in biotech and pharma, retiring as vice chairman of Cowen and Company in 2006 after 13 years at Payne Webber. He is co-founder and a chairman of a not-for-profit organization called Foundation Santé, supporting young scientists in Greece and Cyprus. He served on the boards of Visitors of Duke Medicine and the Global Advisory Board of the Duke Institute for Health Innovation. Dr. Papadopoulos was faculty member, he's a scientist, in the Department of Cell Biology at the NYU School of Medicine and holds advanced degrees in physics, biophysics, and of course, finance. Stelios.
Thank you. I've got my own. Karun decided I should be mic'd for greater effect. By the way, I'm one of the 50 most influential Greeks in healthcare. Just to carve out my own space in the universe. Look, thank you all for having us here. We want to talk about something today which is probably near and dear to the hearts of many of you who are involved primarily in the smaller companies that need financing, and is the state of the capital markets. And these guys here, and maybe they'll each say a few words about themselves before they start, have been around. I've known all of them since they came into the business. You know, I've known Rajiv since he started, Kris since he started, all of them. And they're great guys. And they bring together a very insightful and unique point of view. Some would be somewhat pessimistic, some would be optimistic, and we'll choose them along the way. But just before we even get into the discussion, Steve, you want to say a couple of words about your background, and then we'll go down the line?
Sure.
I feel badly. I mean, he just read up the Bible about me, so I don't want you guys to be shortchanged.
Well, I don't feel that way, Stelios, so always in your presence. I was originally educated and trained as a physician a long time ago, and have been in the industry for a long time. In the last 22 years, had a venture capital firm called F Prime.
I'm Rajiv Kaul. I manage the biotech funds at Fidelity. I think this might be my 30th year in investing in biotech, maybe next year. Just sort of insane. I went to Harvard as an undergraduate, and since then I've been doing this. I am involved with the academic world quite deeply in the last several decades as well. I'm associated with the research board at Mass General Hospital and research board at Scripps, and also as well as at the stem cell labs and at Boston Children's Hospital.
I'm Kris Jenner, like Stelios and like Steve, started scientifically and medically. I received my DPhil from Oxford and then trained as a general surgeon at Hopkins, and then did a big change in career and went to T. Rowe Price for 15 years, and then stayed in Baltimore, and 12 years ago, a handful of colleagues and I left to start Rock Springs Capital, which is where I am now.
Francesco de Rubertis. I'm running Medicxi, venture capital firm in Europe. I'm a molecular biologist by training, but I started in venture 27 years ago. Thank you.
Yeah, and for the record, I started 40 years ago. It's kind of sad, but so I used to try to sell stock to these guys when I was an analyst and a banker. So I've dealt with them in a variety of ways. So let's start with Kris, if we may. Just your sense of a quick overview of the public markets. Not a great surprise to anybody. They're a little crazy, but what is your take?
Yeah, I think I'm not going to say anything that everybody in this room doesn't already know, but we're kind of just bouncing from one headline to another, right? And I think it's been said in many different ways, but somewhere within everyone's description is the word uncertainty. And so I think it's another truism that people appreciate, that that is the real enemy, of kind of sustained and, kind of investment results. It's the world that we live in. But at our breakfast earlier this morning, Rajiv said it. I was sitting next to Sam Waxel. He said it. I think Warren Buffett has famously said it many, many times. And so in honor of his retirement at, age 95? Yeah. That is amazing. That gives me hope. I've got 32 more years to go. But, in one form or another, everyone has kind of said, and much of investment is really pattern recognition. And the pattern that we see today, and I'm just really paraphrasing what some of my, really strong colleagues have said, is, be greedy when others are scared and be scared when others are greedy. And I think, Rajiv will probably elaborate on this theme. And Sam leaned over to me and said, when he was on a, NIH selection committee for, immunology, he said, the more money that we had, the worst projects that we ultimately picked. And so I'm not in any way trying to suggest that, at this moment in time, it's the best of times, but I think in these times we will look back and say some of our best decisions were made.
Well, Rajiv, that brings you up because you're going to have the positive, somewhat contrarian view.
Yeah, I think Kris and I share that philosophy. We've known each other for a long time, invested in many successful biotech companies together. So I would say that's the operating motif right now. At the same time, you can't forget the fundamentals of the industry, which is this is a very good way to lose a lot of money. So, it's like it's an industry built on boom and busts, hope and disappointment. Most drugs still fail. It's extremely hard to do. It's not for the. It's got some of the smartest people in the world. It takes a long time and a lot of money. And so it's not an easy place to be investing in. So that's the nature of the business. So you still have to be a fundamental investor, a stock picker. You have to pick the winners. They're few and far between. You've got to find those breakthrough drugs. And the other factor I would say that's a challenge in the industry, which has been maybe underestimated by me up until maybe the last few years, is just the competitive intensity. And one of the challenges has been this access to very low capital for a long time, and lots of money going after the same targets, the same types of molecules, little tweaks, and that has not necessarily been a positive thing for the industry. So, those are other things that one needs to also keep in mind. But I think the general motif of investing when times of uncertainty, especially. We've really been, I think, in a bear market now in biotech since 2021. Some of the valuations at certain points, including 3 weeks ago, were at historic lows. I think 20% of the industry of the public markets were trading at cash or below cash. On an EV to cash basis, it's below the dot-com, the bottom of the dot-com bursting of the bubble in 2003. So certainly, and there's all this negative uncertainty around drug reimbursement, pricing in Europe versus the United States, taxes, tariffs, FDA. I mean, you can't, all those things are like terrible. But historically, we've been through other times of great uncertainty. They've generally been great opportunities to buy those breakthrough drugs, and across most industries, if you see. The biggest companies in the world today, they were all sort of born during periods of crisis or during downturns. Tech is a great example of that as well. So I think that is the sense and the guiding sort of light by which I like to think about this moment in time.
So let me challenge a little bit this opportunistic approach to investing, the Warren Buffett way of, trying to get into situations when others were getting out. A lot of what, and I'm complicit. I've been thinking and acting the same way over my 40 years, personally and professionally. But the one underlying theme when you do that is you have a pretty reasonable sense of where things will end up once this crisis is over. And the assumption fundamentally is that we'll be back to normal. This is just an exacerbation. You'll be back to normal. Let's take advantage of fear and greed, and we'll do that. My challenge right now is I'm not sure what the next level point is going to be. Is it going to be the old normal or a completely new normal where everything is redefined? So what do you guys think about that? I mean, maybe back to you, Kris.
Well, I guess, I hold on to some kind of fundamental tenets, which is, are we still an affluent society? So while, this is an issue, and it gets increasingly difficult every year, are we an affluent society, and more or less can we, to a certain extent, afford important innovations? So that's kind of could be debatable, but that's a belief. The second is, does everybody in this room want to live longer and have a higher quality of life? I think that that's also a truism. A third is, have we successfully met all the unmet medical needs? So I certainly believe that we haven't, and so I strongly kind of, believe in that. The fourth that I hold on to is, and it was mentioned earlier, but you think about, small and mid-cap companies, and I think, that's analogous to saying the biotech industry, but is that a national resource? Is that a competitive advantage? And, I certainly think that it is. And then the fifth is, do we have the necessary elements for an infrastructure to kind of make the elixir work? So somebody said it earlier, do we have talented scientists? Do we have the, kind of preeminent biomedical infrastructure in the world? And do we have a capital markets risk-taking environment that kind of makes this all happen, and a sufficient number of examples that people can look towards and say, if you do this and put one foot in front of another, this can lead to, tremendous benefits for all the, for all the stakeholders. So I go back to this, Howard Marks wrote it, his memo entitled, and I think it's been said here again by many people in different ways, no one knows, right? No one knows. So you do have to hold on to some things that you think you know. And so to answer your question, Stelios, I don't know what the new normal is, but there are certain things that I think that I hold on to be true. And if you hold on to those things, I'm a believer that wherever the new normal is, those things will have some element of truthfulness as a part of it. So that's kind of, my guiding principle.
Well, I'm certainly encouraged now, but hearing that, Steve, are you busy trying to start a bunch of new companies because you want to be ready for
No,
when
but
these
Stelios,
good times happen?
be careful.
Me or Steve?
I spoke in generalities. Now, let's be specific. Do I think that this is the right time to go out and start something new that is going to take multiple years, have tremendous capital needs, and have an uncertain payoff with an uncertain future? Not necessarily, but I do think that, and Rajiv mentioned this, that there are many companies that are out there and have been out there that are incubating, and either have demonstrated that they have important therapeutics or are very close to doing so, that have been at this for multiple years, at the same time that, as Rajiv mentioned, we've been effectively in a stagnating market, since February of 21. So I just want to be careful that I'm not kind of advocating for going out and starting something today. I'm very much in favor of going out and kind of looking at all the things that have been out there, that have been making tremendous fundamental progress, but haven't really been recognized for one reason or another but are on the cusp of doing something really important that in years to come will reap the rewards.
So I'm neither agreeing or disagreeing with you. I'll reserve the right to come back and offer an analogy of another era, another time. But I still want to ask the question of Steve and then of Francesco. Do you feel compelled to go start companies right now, anticipating, the good days, 2 years down the line, 10 years down the line?
Well, we do, because that's what we do. I actually think Kris, that articulation and the couple of points, he made very eloquently, I think is why we still have lots of hope. And I would add one more, which is that I think that this century is the century of medicine, and that this is a time at which, I'm old enough to go back to my medical education and training, that I was mostly shocked at how few things we did cure in medicine, and that has actually changed over the last 40 years. There was no biotech industry. You remember what the pharma industry then, it was mostly chemical engineers in short-sleeved button-down shirts and pocket protectors and doing good work, but it wasn't, you didn't have the best and brightest necessarily from medicine going into it. It was something that was considered a career. I think Susan mentioned Yale when she was there. We actually overlapped for a period of time. The idea of university, of anybody in a university going into biotech, was apostasy then. So that has changed, and I think that now there are parts of the industry, there's so much unmet medical need. So that's a fundamental truth. But at the same time, there are certain areas where now we're starting to apply engineering principles, which is very different than kind of trial and error in medicine. And then I'd say the one difference is we still are starting companies, but now at this time, because you alluded to previous times, 2001, that was a long stretch. And I suspect that each 2001, 2008, even 2015, which was a little bit briefer, those were not periods that were over in a couple of months. It took years, and I think for different reasons. But during that time, I think one of the things that we certainly look at is when we're starting something, we want to have a clear idea of what it is. And I agree with the point that the two Krises made, that times of surplus, and I don't exclude us from that period, 21 to 23, because we are always behind the public markets. You guys are always sharper, I would say there was so much money that lots of things got funded that maybe shouldn't have been funded in ways that maybe shouldn't have been funded. But right now, when we fund things, we don't want to count on having to raise a Series B. We want to have a syndicate that has groups that we trust in terms of the vision and their commitment to the company, and also have pockets that are deep enough that if we have to go through a tough period, which we expect, we'll be able to do it. So at least that's our plan. So
Hold that thought about 2001. It's a magic number. I'll come to that.
Yeah.
Francesco, what are you doing right now?
Not changing at all. So certainly, the bad weather that it's out there doesn't help, but it doesn't impact, importantly, the way in which in Europe, with a European investing style, we're doing startups. So we are creating companies at the same pace as we were doing before, which is low pace. Clearly, what changes is the way in which we need to think about funding these companies. As Steve is saying, the ways in which we start companies is very, very focused on single projects, very identified ideas, scientists that come out of their labs with the idea that they think is the best idea ever, which is as it should be. Those are the things that we keep on funding in good times and bad times. The way in which we invest is a little bit insulated from the capital markets simply because we are we have a model that is less capital intense. And so we really focus on the ideas that scientists across Europe mostly come out of the labs with, and we see them in very small entities. Of course, a small entity means that before they come to the moment in which where the public markets is, where the big guys on the public markets are, there is a few years before that moment comes. And so we have got that perspective that we can put into our investment. But so our investment model, approach, pace is largely unaffected in good times and in bad times.
So back to this 2001, part of the challenge, I think, in our business, and I'm sorry I'm not looking at this side. I should be turning my chair around, just to be fair. Part of the challenge in the biotech world and pharma world, to some point, is the absence of institutional memory. Most people today in biotech started in the last 15, 20 years, which means they don't remember the year 2000. They don't remember the year 1991. For sure, they don't remember 1984. I can tell you, talking about a time of devastation, 1984, you couldn't give away a biotech stock. It was so bad. I got the idea in October 1980 to get into biotech when I saw the IPO of Genentech, and talking about academia, and I was so preoccupied with this notion. I wanted to just learn to behave like a Wall Street person. I started wearing a suit to the lab. And then I got the guy I was at NYU Medical Center, the guy who was delivering newspapers to the patients to come around the lab and get me the Wall Street Journal every morning so I can read it and learn how to talk like a finance person. And I was going to business school at night. So it was a lot more challenging then than it is now. When at the drop of a hat, if you still got the goods, you can raise $200 million overnight. So it's not that bad. But the point is, 2000 was one of those years of excess, like 2000, 2021. By the end of 2000, pretty much every IPO, there were 68 IPOs in the year 2000. It was then by far the record. By the end of the year, 90% of them were trading below issue price. In 2001, it was dead. Nobody wanted to invest in biotech. And that lasted 2 or 3 years of extremely bad markets. When the market for IPOs came back in October 2003, the first IPO was Accusphere, a little company I was involved with as a banker. And for several years after that, the IPOs were all companies a little along the line of what Kris was suggesting. So like late stage, repurposed drug, regurgitated ideas, because people felt, I'd done an analysis that I published and presented many times, that if you look at the IPO performance of the year 2000, though there were deep science, technology platforms did a lot worse than those that were more specific, more pragmatic, more product related. So people, venture capitalists being smart, responded to the need of the market, started starting companies that looked like what the market wanted. I actually called the 2000 the lost decade because hardly any innovation came out of those companies. The most totally forgettable companies. You want to interrupt, please do.
Can I just have a quick response to that, and then we can have a more detailed response. Which was the best number one performing stock in the entire S&P 500 during the 2000s?
The 2000s?
Yeah.
Is it Illumina?
Genentech. What was
okay.
What was the second one? Gilead. Yeah. What was the third one? Celgene. So please keep that in mind too.
Yeah. What endpoint are you choosing?
That's the decade. At the end of the decade.
The end of the decade, actually.
Over the whole decade.
It was 2011 that brought about the current market when the big four started hitting product after product, beating quarterly earnings. It was Gilead, Biogen, Amgen.
No. Roche bought Genentech in 2009 for $100 billion.
No, I understand.
And Avastin,
yes.
was in 2003, I think, the first study.
But the vast world of biotech is the little companies.
Well, that's maybe part of the deeper discussion.
Yes.
As well.
Stelios, it's not only because I'm a sycophant, but I want to back you up on that. I mean, here's where the public markets are. I mean, that's the truth.
I disagree all the time.
Yes,
this is part of the course.
Yes, I think that's a truth.
Even in the last 5 years, the most innovative companies have been the larger companies. I mean, one needs to have some humility about this when one talks about small biotech companies in Boston, Cambridge. innovation infrastructure, because we want these small companies to break
But
through and do great
Rajiv,
things.
Gilead, great stock, great performance, was founded in the late 80s. It was not a 2000 plus founding.
The HIV drug had the positive phase 3 data for the Variad drug in I think they launched it right before 9/11, and the stock crashed along with everything else. And then it was this bear market in biotech 2001 to 2003 as well continued.
So sales
and
drove
Gilead
it.
was up 10x during that
Sales
period.
drove it.
Pharma said it's the same story later in the decade.
Yeah, that was 2011.
Pharmacyclics is
Okay.
also later
All
in
right,
the decade.
Steve wants to speak.
No, I was just.
This will be the most entertaining
both
panel
things
of
actually
the day,
can be
for
true
sure.
because
Well, those companies came out of the 2007, 2008 Great Recession. So there was 2001, then there was 2007 and 2008. So anyway, I'm sorry I jumped in there. I had to.
No,
respond.
all those are true. I mean, those were great companies that had
They're
large
highly innovative.
R&D.
They were hugely innovative companies. I
Yes,
mean, we
with
solved
large-
the HIV problem. You had Avastin, which really broke the solid tumor barrier.
I'm
I
not
mean,
disagreeing.
You know,
So-
okay,
so
target medicine.
they are great companies.
Antibodies, the
That-
whole thing.
They
with
are great
antibodies.
companies.
But-
Yeah. So I
mean,
wish
but
we.
there's
But
the other one,
the
you
only
know.
thing I
Oh,
wanted
you
to.
know, wait a second.
Stelios,
Let's get
sorry.
Steve to finish.
Stelios, so what is your point?
My point is when we go into periods of market duress, when we go into times of lack of attractiveness for the sector, the VCs manufacture late-stage companies and avoid deep innovation. And that has long-term effects.
So
that's my point.
That was the part I was going to completely agree with. So there were these great companies that were continuing to plow through and doing the great stuff that they
Is it getting
were doing.
romantic in here?
And Genentech is such a good example because they continued to do what they were doing. I think that the disagreement is that I would say in the venture world, by and large, what Stelios just said was true. Everyone was going after Me Too drugs in that time. We were in part, and I know this, there was even a Harvard Business School professor, Gary Pisano. I don't know if he's still...
Oh, yes, yeah. The lemon hypothesis.
Yeah, well, he wrote a book called Science as a Business.
Yeah,
And
the business
part
of
of it
science,
was
yeah.
the business of science. Part of his argument was it was impossible to ever make money in venture in biotech, and so that the government actually had to come in, or a model was is that the government would come in and support it. We just happened to be lucky at that time that we were just starting out, and we didn't know what we were doing. And so we actually went after rare disease. That was a contrarian bet. And that first one, I think I was, Francesco, you were talking about how, sometimes you're just lucky, and so that contrarian bet was FoldRx, which had tafamidis that we started, which now, going after TTR amyloidosis. That was a contrarian bet, and I think that the only point is, and maybe it's the subtext of what you're saying, is don't pay attention to the herd right now, because you're going to have to pay attention to the fundamentals of doing great work at a time when it doesn't make any sense. And that gets back to, I think your point is, and Francesco's point is, just keep doing what you're doing, but you may have to do it with more resources and a different time horizon, because it's not like it was.
That is better than what I've said. In fact, can I just get you to come home with me when I argue with my wife? You present my case.
If you can come home with me, because I never have won an argument with my wife.
Fine, deal.
and
Francesco.
And Steve, after you kind of test out your hit rate at Stelios, come to my home then.
Francesco, what do you think about all of this? Is Europe sort of like a protected place that you sit far away, the noise that goes on day to day doesn't affect you?
No. I would say that there is a structural difference in the way in which we do venture capital. And I will just speak from the perspective of venture capital. The way in which we do venture capital in Europe is generally different from the way in which it's done in the US. I do believe that the pharmaceutical businesses and biotech businesses are different businesses. I think it's really optimistically blind to wanting to create a startup with the full infrastructure, like if it was a pharmaceutical company, which is already running on real assets. Creating a company, locking yourself in an infrastructure cost, in a fixed cost that will say, for the next 5 years, you're going to spend, no matter what, $150 million. And maybe there's going to be 1, 2 drugs, if you're a good one, that is going to come out. you're going to lock yourself into a structure of cost, which basically puts you in a certain kind of game, which basically means because in the US there is so much capital available for startups, that is what happens in the US, God bless. And there is a lot of companies that after years and years and years will be able to innovate. In Europe, there is not a lot of venture capital. 5 VC firms cover 80% of the market share in Europe. So the absence of capital is a godsend in Europe, because then we have to think, no, there is no company with $100 million infrastructure cost to be funded. Is that product that you have in your mind, that doesn't exist even in the chemistry lab yet, but is this product really worth it? If the vision of the scientist is so compelling that he or she will come out of the lab and commit to a excruciatingly painful single asset build out company startup, then we'll fund it. But we'll fund it with no infrastructure, just on a variable cost basis. And that really is not now in the downturns or in the upturns. I've been doing the same thing for 27 years. Not really, for maybe a little bit less when I learned. So 23, 24 years. I do not want to fund infrastructure for things which are not asset. An animal modifying behavioral molecule is not an asset. It's a tool. It's a great insight. It's a great tool. It will become an asset after statistical phase 2 data or statistical phase 3 are available. Between now and then, it's a path that we need to build. I know it's not romantic as a way of building a company or doing a startup, but it is the pragmatic way in which we can make use of the capital that we have in Europe to really, as I was saying this morning in the advisory board, in the end, 10-20% of the yearly drugs that the drugs that yearly get approved at the FDA level are molecules that were discovered in Europe one day. I'm not saying thanks to Medicxi, of course not. I'm saying through the discovery labs in Europe. So there is that kind of knowledge and science basis that needs to come out. The only way in which we can do in Europe, in good weather, in bad weather, with Trump, without Trump, with wars, without wars, is in that non-romantic, project-focused, non-Wall Street news title kind of way, which is, however, what, in terms of numbers, it's really turning out to be a useful way. So there is no change for us when the weather is bad out there. There is always changes, of course, because when we are selling the company to Andy, he negotiates harder because, oh, look at the inflation, look at the bad weather, so he will negotiate down our prices. But in terms of how we do the investments, that doesn't change as a function of the bad weather.
So let me ask you
He's
a
a
question,
tough cookie, this
Francesco.
Andy. So I may interrupt
Sorry,
again.
I'm just seeing Andy there. If there was someone else, I would. If there was Kris. But anyways, sorry.
Francesco, let me ask you a question. I'll ask the rest of the panel the same question. Given what you just said, how would you feel about a bunch of companies we've seen in the last few years that sort of get unveiled with 100 million of Series A, having spent already 50 million in stealth, and attempt to solve a fundamental biological question through platform creation, the combination of machine learning and great ideas and all of that? I mean, you wouldn't invest in any of those, I take it.
I would not invest the capital of a venture firm like mine that has got 10 years of life on the fund. So everybody has got a game that has to play. So a foundation has got a game. A public market investor has got a game. As a venture capitalist that I'm being called to report on the institutional money that I manage, on a fund that has 10 years, I cannot take that bet because I cannot believe, or I don't believe that I cannot build a business on exceptions. Okay, that's nice, but it's not everything Genentech. I would love everything would be Genentech. I need to build a business as a venture capital firm that is more predictable, so it's difficult to bet, even though the exception makes the rule, right?
Stop right there. Your first investment that made you was Genmab.
Yes.
Highly uncertain at the time you put the money in. Cellzone came next, highly uncertain. Does this mean that at different time in one's career, in one's fund, you do different things?
That's a great question, Stelios. Thank you. My first investment 27 years ago, when I started in venture, I was discussing with Steve, was the seed round of Genmab. Doesn't get more lucky than that. I cannot say that I'd seen where this was going at all, okay? It was just the first investment that I did. I got really lucky. People started to think, my investors, my partners, and the LPs, oh my God, you're really good. Genmab seed round. I took it. my return on investment on Genmab, and I think Genmab is a supreme company, is a fantastic company. Okay, the quality that's produced is fantastic. I made an average return. I don't want to disclose numbers which are proprietary, but I was not happy with the return. I made several times my money, but if you see the company that will become the biggest company in Europe, you want to do a stupid return. Not because I'm greedy, not because I'm a venture capital, but because I need to think about the sustainability of a business model. That is when I was lucky that it was my first investment, because 3-4 years later, I said, okay, this cannot be. I was at that point almost 30. I said, okay, this cannot
Almost
be.
30.
Yeah.
I'm 77. Give me a break.
All right. I was 31, maybe. But so I said, if I make this return on investment on Genmab, there's no point in being venture capital. That is when I decided that the classical way of building a company with Genmab being a supreme company, I use Genmab not because it went wrong, or it's a great company that delivered incredible value to our friends at J&J, for example. But so it's a great company. Even doing that, there is no venture capital return in there. It's not good enough to be sustainable because I need to have a lot of write-offs. Otherwise, I'm not really investing in something real. And so because of that, because they were coming early in my career, even Cellzone, the company we did together, you did, and then you allowed me to be part of that story. Fantastic technology, fantastic platform. Even to date, GSK makes a killing out of that platform. We, with our timelines, which is the game that we have to play, 10 years funds, we use the entire 10 years to allow the demonstration of the technology. And by the time we were done, there was no return on investment, big upside for the venture investors. So even though it was a very successful experiment, Cellzone, in terms of venture capital model, I said, if this is what venture capital is, it's not sustainable. Because how do I fund all the unsuccessful companies for the successful Cellzone and Genmab? So it's not that it was a different time. It was my earliest time. I would still do some exceptional situations, platform companies, but I really need to believe that those platform companies that I would do today change the face of the industry. It's not many of those opportunities, right? But so that is why I became pragmatic and non-romantic from the early days when Genmab was, remember, it was a spin-out of Medicxi back then, right? So yes, of course, you're back in that story. But anyways, that is the reason.
Anyway, I know Rajiv is dying to jump into this mega platform companies.
I was going to give kudos to Francesco for saying this because I think it's important to really recognize that. And there's a truth and honesty to that that I really respect. There are other groups that I talked to in the last few years that have raised a lot of money on the VC stuff, have big visions around it. But the goal is not to actually necessarily get these drugs to, the goal is that. And I don't think there's a cynical view around this. I think it's just the incentives and the structure of the institutions. Ultimately, you would think if you're taking all these risks, you want to get these drugs to the patients, and you're going to change people's lives, you're going to add value to society, you're going to make a lot of money. But that's not how it works. Most VCs don't wait for 10 years to raise their next fund. They want to wait for 2 years, and then they raise their next fund, and then 2 years, and they raise their next fund. So you really don't know what the output of those investments are. What you're hoping for is that somebody else is going to come and pay a higher price for it. You kind of package it in a way that you can sell it either to the public markets or to a larger pharmaceutical company or, and try to play that cycle. Because the fee structure is based on these sort of unrealized returns. And, this happens across the board and across the economy. And it happens in a lot of different, not only in venture capital funds, but in other institutional investment funds too, that the investment business makes its money by charging fees. The people that run those funds tend to do pretty well. I'm really not sure what the real returns are to the investor at the end. And it's very disconnected from what you would think. At least it's very disconnected from the way we talk about this platform and innovation. I'm going to change the nature of medicine. The translation of that does not really occur. Is not what really drives the returns for a lot of the players in the industry.
Well, I know we're running out of time, and there were some designated questioners, but I may even forgo those. There's one very important question I want to ask of all of you guys, and Annie and all of you can answer quickly. In prior cycles of market distaste for early stage investment. One thing that remained pretty much constant in the background was the pharma industry as the acquirer, the opportunity of last resort or whatever. But as we go through this turmoil in our markets, this huge uncertainty, pharma itself is going through enormous changes. And that may change the structure, the nature, the opportunity, if you wish, for takeouts. So how do you factor this in your investments? I don't know, starting with you, Steve.
Well, as bad as that is going to be, I suspect that the IPO market will be even worse. And so I think, as Francesco said before, the prices might be lower.
But Andy will always be there.
Well, I don't know if he'll always be. Well, he always will be there. But I think back to, I mean, centering, and we have certainly done a lot of platform stuff over the years, but we've balanced it with some of the assets. And Francesco is, in some ways, he's weatherproofed for a time like this. I mean, it's a great strategy, and I suspect that there will be more of it. It's just now you're going to have lower some of the expectations or make sure that you can last a longer period of time and you have the resources to bring it to the next stage at which you prove it. I think that Andy will always definitely be there if you have a real drug that's meeting a real unmet medical need, and it's not still a dream. It's actually, yeah. And I think that has been one of the positive developments is over the last 40 years, not exclusively, but to a limited extent, large pharma has outsourced innovation to an industry that is even more risk-taking and is able to interact in a more intimate way with academia. And so I think that has been a positive thing over the last 40 years. And I suspect that will continue. It's going to be different for the next couple of years.
Rajiv?
So I've always think about M&A kind of like a steady drumbeat. It is present, sometimes it's louder, sometimes it's more faint. But I think it's a numbers game. There are many, many more smaller companies, and there are many fewer large companies. And they're they don't make a perfect mix, but I think that the way I think about it as an investor on behalf of our clients is that we're looking for the same thing that large pharma is, which is value and duration, and so I don't view it as a necessity, but I do think that it will continue to be present. And I would say that were it not for tariffs, MFN, and 340B and Medicaid concerns, like we would be in the midst of it right now. But I think it has been put on pause for various, obvious reasons.
Francesco, final word.
70-80% of our companies end up in the hands of Andy and Andy's colleagues. 70-80% it's M&A. So for us, it's really important that there is, the consolidation is a big issue. But honestly, when we look at all of those 70-80% of our exits, there is two bidders, maximum 3. So I do think that that the critical mass is going to be still there for that not to be a material dominant impact, even though we are completely M&A focused more than public market focused.
And with that, and being a minute late, thank you very much, gentlemen. Thank you.